Forget the silver hype for a moment. Forget the election cycle. Forget the daily soap opera of American politics. Most of them are only distractions. They are a light show designed to keep your eyes fixed on the stage while the theater itself is burning down. What if I told you that the trigger for the next Great Depression didn't just get pulled in New York or Washington, D.C.? What if I told you the bullet was fired from a quiet, sterile boardroom in Tokyo, and it is currently traveling across the Pacific Ocean at the speed of light, aimed directly at the heart of the American economy? Most people are looking at the U.S. stock market and seeing all-time highs. They see a tech boom, but the smart money, the sovereign money, sees a trap door opening. We are witnessing the beginning of a $100 trillion margin call, a financial tectonic shift that makes the 2008 crisis look like a dress rehearsal. The media tells you the story is about inflation or employment numbers. That is a lie. The story is about a relationship that has defined the global economy for 30 years, and how that relationship just violently ended. It is the story of how the United States lost its biggest lender, how the Japanese yen became the needle that pops the American debt bubble, and how China is quietly moving to the exit door, carrying the only asset that will matter when the dust settles. This is not a correction. This is an unwind. And when the unwinding finishes, the financial map of the world will look nothing like it does today. If you are ready to see the mechanism behind the curtain, hit that subscribe button right now. We don't cover the news here. We cover the history of the future. And you're going to want to be notified before the rest of the world wakes up. To understand why the American system is blinking red, you have to look away from America. You have to look at the silent partner. For decades, Japan has been the world's ATM. It has been the patient zero of the modern economic disease, a zombie economy kept alive by infinite money printing and 0% interest rates. For 30 years, the Bank of Japan printed yen and practically gave it away for free. Investors, hedge funds, and banks took this free money and flooded it into the rest of the world. This is called the carry trade. It sounds technical, but it's actually very simple. It's an addiction. Imagine a bank that lets you borrow billions of dollars at 0% interest. What do? You borrow as much as you can, and you invest it in things that actually pay you. US Treasury bonds, US tech stocks, real estate. You pocket the difference. It was free money. It was the liquidity that lubricated the gears of Wall Street. It kept US bond yields low. It kept the American housing market floating. It was the invisible subsidy that allowed the West to live beyond its means. But here is the detail the financial news glosses over. This money wasn't just invested, it was leveraged. Hedge funds didn't just borrow yen to buy stocks. They used it to buy options on stocks, amplifying their bets by 10 or 20 times. The entire AI boom, the meteoric rise of the Magnificent Seven, was partially fueled by this ocean of cheap Japanese liquidity. It created a false sense of invincibility. But last week, the ATM shut down. The free lunch is over. Japan is facing a crisis that the textbooks said was impossible for a developed nation. Inflation has finally breached the walls of Tokyo. After decades of deflation, consumer prices are rising. The Japanese yen has been collapsing, losing its value so fast that it threatened to destroy the purchasing power of the entire Japanese population. So, the Bank of Japan had to make a choice: save their bond market or save their currency. They couldn't do both. And they chose the currency. They pulled the trigger. They raised interest rates. This sounds small, a fraction of a percent. But when you have a mountain of debt the size of Everest, even a tremor causes an avalanche. By raising rates, Japan signaled the end of the cheap money era. And now, that massive river of capital that flowed from Japan to the US is reversing. It is flowing back home. You need to understand the physics of this. When the yen rises, the algorithms that run Wall Street trigger automatic sell orders. The traders get a margin call. They have to sell their most liquid assets, US stocks and US bonds, to pay back the Japanese loans. This is why when Tokyo sneezes, Silicon Valley catches a double pneumonia. We are seeing the first cracks in the AI bubble not because the technology failed, but because the financing dried up. We are seeing yields on Japanese 30-year bonds spike to levels not seen since 1999. The spread, the gap between US and Japanese rates, is closing. And as that gap closes, the incentive for Japanese investors to hold US debt evaporates. Why does this matter to you in Ohio, or London, or Sydney? Because Japan is the largest foreign holder of US government debt. They hold over $1 trillion of US Treasuries. They are the whale that keeps the US government funded. If Japanese rates rise, domestic Japanese investors, who hold trillions in US assets, will sell those US assets to bring their money back to Japan for a safer, higher domestic return. This is the great unwind. When the biggest buyer of US debt turns into a seller who buys the debt, who steps in to fund the US deficit when the Japanese walk away. This is where the nightmare begins for the US Treasury. Because at the exact moment Japan is leaving the table, the US government is borrowing more money than at any point in history outside of a world war. The US national debt is sitting at $38 trillion. It is growing by $1 trillion every few months. The interest payments alone on this debt are now higher than the entire defense budget. The US is borrowing money just to pay the interest on the money it already borrowed. It is a Ponzi scheme that only works as long as there are new investors entering the bottom of the pyramid. Japan was the biggest investor at the bottom of that pyramid, and they just quit. So, look at the reaction from American policymakers. It reeks of desperation. We are seeing proposals to deregulate the banking system, led by figures like Scott Bessent. They want to take the chains off the banks. They want to lower capital requirements. The media spins this as pro-business or unleashing the economy. That is the cover story. The reality is much darker. They need to deregulate the banks because they need to force the banks to buy the US debt that Japan won't buy anymore. They are engaging in financial cannibalism. By loosening these regulations, rules put in place specifically to prevent another 2008 crash, they are effectively turning the US commercial banking system into a dumping ground for toxic government debt. They are loading the balance sheets of banks like JP Morgan and Bank of America with treasuries that are losing value every day. They are sacrificing the safety of your bank deposits to keep the government solvent for just a few more quarters. It is a calculated gamble with the public's money. It is a desperate shell game, and the credit rating agencies are starting to notice. Scope Ratings, a major European agency, just downgraded the US from AA to AA-. The US is no longer the gold standard. In terms of creditworthiness, the United States is now falling behind countries like Sweden and Norway. It is barely one step ahead of China. Think about that. The issuer of the world's reserve currency, the supposed rock of the global financial system, is being viewed with the same skepticism as an emerging market. This brings us to this sound familiar moment. Look at Japan today. A debt-to-GDP ratio of over 250%. A government that spends 25% of its annual budget just servicing debt. A central bank that owns half the market. A zombie economy that cannot survive without artificial life support. Does that sound familiar? It should, because Japan is the ghost of Christmas future for the United States. The US is following the exact same playbook, step for step, disaster for disaster. The US debt-to-GDP ratio is climbing rapidly toward those Japanese levels. The interest costs are eating the budget alive. The only difference is that Japan had a savings surplus. The US has a deficit. Japan funded its own debt. The US relies on the kindness of strangers. And those strangers are becoming less kind by the day. While the US scrambles to manipulate its banking rules and Japan struggles to stop its currency from imploding, there is a third player on the board. A player that decided long ago that this game was rigged and decided to stop playing entirely. China. While Western media obsesses over trade tariffs and tech bans, Beijing has been executing a different strategy. They are conducting a quiet, systematic exit from the US dollar system. For 20 years, China recycled its trade surplus into US Treasuries. They sent us cheap goods, we sent them IOUs. That cycle is broken. China's holdings of US debt are dropping month after month. They are not rolling over the debt. They are letting it expire. They are selling into the rallies. But here is the key question. If China is selling billions of dollars, where are they putting that money? They aren't buying euros. They aren't buying yen. They are moving into the only asset that has no counterparty risk. The only asset that cannot be printed by a desperate central bank. Gold. But you have to look closely at how they are doing it. This isn't just about the People's Bank of China reporting an increase in reserves. The official numbers are a fraction of the reality. Global banks estimate that China's real gold purchases are 10 times higher than what they report. They aren't just buying gold bars on the London Exchange. That is retail thinking. China is thinking imperially. They are buying the supply chain. Look at the recent moves by Chinese state-linked companies. CMOC, a massive Chinese mining giant, is moving to acquire gold mines in Brazil. They bought a Canadian company to secure mining rights in Ecuador. They are planting flags in the resource-rich soil of Latin America. This is part of a broader resource realignment. While the US fights culture wars, the BRICS nations are fighting a resource war. They are securing the copper, the lithium, and the gold, the actual atoms that make up the modern economy. China understands that in a currency collapse, he who holds the paper dies, but he who holds the mine survives. By buying these assets in Brazil and Ecuador, they are effectively backing their future financial system with the periodic table of elements, while the West backs theirs with debt ledgers. And then, there is the domestic discovery. In November, the Chinese government announced a massive find in the province of Liaoning, a deposit estimated to hold over 1,400 tons of gold. That is $170 billion worth of metal sitting within their own borders. This is not a coincidence. You do not announce a discovery of that magnitude unless you are sending a message. And the message to the United States is clear. We have the collateral. You have the debt. China is building a gold wall. They are encouraging their citizens to buy gold. They are expanding gold ETFs that store bullion in Shanghai, not in New York. They are creating a closed loop of real value that is insulated from the coming dollar collapse. They see the writing on the wall. They see Japan raising rates. They see the US banking system shaking. They see the US Treasury printing money to pay interest. They know how this movie ends because they have read the history books. When a reserve currency dies, it doesn't happen linearly. It happens exponentially. It happens slowly, and then all at once. The mechanism is set. The yen carry trade unwind forces selling of US Treasuries. US yields spike. The US economy, which is addicted to cheap debt, begins to seize up. The Federal Reserve is forced to step in and print trillions to buy the bonds that Japan and China won't touch. This printing triggers a second wave of inflation, destroying the value of the dollar. And as the dollar falls, the cost of everything you import, energy, food, electronics, skyrockets. The standard of living in the West collapses to match the reality of its balance sheet. The illusion of wealth that has been maintained by cheap imports and strong currency will shatter. You will wake up to find that your house price is up, your stock portfolio is up, but you can't afford a gallon of milk. That is the final stage. This is the trigger we talked about. Japan pulled it. The bullet is in the air. The US dollar index has been strong recently against the yen, but that is a mirage. It is strength based on the weakness of others, not the health of the dollar itself. It is the cleanest shirt in the dirty laundry basket. But when the laundry goes into the incinerator, it doesn't matter how clean the shirt was. The smart money is doing exactly what China is doing. They are getting out of paper promises and into hard assets. They are looking at the ratio of gold to debt and realizing that gold is not expensive. It is historically cheap compared to the amount of money that has been printed. We are entering a period of financial warfare where the weapons are interest rates and the casualties are your savings. The Japanese are trying to save themselves. The Chinese are fortifying their castle. The American elite are trying to change the rules of the banking system to keep the game going for one more round. But you are not a central bank. You cannot print your way out of this. You cannot change the laws to suit your portfolio. You have to live in the reality that they are trying to hide. The reality is that the era of the US Treasury as the risk-free asset is over. When the largest creditor, Japan, and the largest rival, China, both turn their backs on the dollar, the mathematics of the American empire cease to function. We are watching the liquidation of the old order. The volatility we saw this week in the markets, the spike in yields, that wasn't a glitch. That was the sound of the foundation cracking. Japan just told the world that the price of money is going up. China just told the world that the value of the dollar is going down. The squeeze is on. The question is not if the collapse happens. The question is who is left holding the bag. The pension funds, the retail investors, the people who believe the official story, they are the ones who will be liquidated. The system is designed to transfer wealth from the unaware to the prepared, from those holding paper to those holding resources, from the periphery to the core. Don't be the liquidity that allows the elite to exit their positions. Understand the game. Watch the flows. Follow the money, not the headlines. The Japanese trigger has been pulled. The impact is coming. Brace yourself. If you want to understand the next phase of this collapse and how digital assets might play a role in the new system being built. Make sure you've watched our previous video on the future of money. But for now, secure your position. The storm is no longer on the horizon. It is overhead. Thanks for watching.